traders, for today's trade we're looking at a neutral option play in Dow Jones Component and iPhone maker Apple. This trade is known as an iron condor. The stock has been on a strong move higher so far in 2023, rising in January and February. Despite the ongoing banking crisis, shares have still been continuing to push higher. The stock pulled back slightly to find support at its 50-day and 200-day lines, but bounced last week. However, the stock has been range-bound for quite some time now and has been stuck in a trading range since the end of 2021. The stock remains roughly 12% below a 183.04 buy point from the current consolidation pattern. The chart could also be seen as a double bottom base with an entry 10 cents above the middle peak at 176.15. Traders who think the stock will remain range-bound for the next month could look at an iron condor trade that expires in roughly 4 weeks' time. As a reminder, an iron condor is a combination of a bull put spread and a bear call spread. The idea with the trade is to profit from time decay while expecting that the stock will not move too much in either direction. An iron condor is a risk-defined strategy, which means you know your max loss potential ahead of time, and it's not unlimited. This is a great way to get exposure to a stock without taking directional risk as well. So with all that said, let's take a look at my trading platform and set up this trade.
So for this trade, we'll be using the April 21st expiration for all legs of the trade. For the bull put spread, we could look to sell the 150 put and buy the 145 put. For the bear call spread, we could look to sell the 170 call and buy the 175 call.
We'll be using the April 21st expiration for all legs of this trade. For the bull put spread, we could sell the 150 put and buy the 145 put. Then the bear call spread could be placed by selling the 170 call and buying the 175 call. In total, this iron condor will generate around $1.30 per contract or $130 in premium.
The profit zone ranges between 148.70 and 171.30.
This can be calculated by taking the short strikes and adding or subtracting the premium received. Both spreads are $5 wide, so the maximum risk in this trade is $370. If we take the premium divided by the maximum risk, this iron condor has the potential to return around 35%. If price action stabilizes in the stock, then this iron condor will pay off. But if Apple continues to bounce higher or takes out the buy point before April 21st, then the stock will suffer losses. One way to set up a stop loss for an iron condor is based on the premium received. So in this case, we received $130, so we could set a stop loss at 1.5 times the premium, or around $190. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas. And be sure to join us here for our regular options content where we break down a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.